Let's start with, I mean, obviously your reputation, how you build your business domestically is of primary importance to you.
Yeah.
So the incident on the West is a big deal. How are you addressing it? I know in some ways it's over, in some ways it's not over. What do you say about it?
Yeah, so look, this is an unfortunate situation from start to finish, and it should never, ever have happened. If you think about it, when you have somebody walk into, here we are in one of our branches here, if somebody walks into one of our branches, it should never, ever be the case that they walk out in handcuffs. And that's what happened. That's what happened here. So for that, we apologize. I apologize unequivocally, unreservedly that that happened. There were challenges with respect to validating the customer's ID, but that doesn't matter. That should never end up the way it ended up in this circumstance. And the police shouldn't have been involved, and that's on us, and we take accountability for that. You asked the question, how do we move on? We've had conversations, I've had many of them personally. We're now up to hundreds of conversations with Indigenous leaders, with our customers, with our employees. I want to thank everybody for those conversations because they've been very valuable in terms of our thinking very deeply about the fact that while these are complex issues, they're also very emotional issues, and they touch on a lot of issues with respect to our past that we're thinking very deeply about. And so for us, it's about teaching, it's about learning, it's about investing in the conversation to move forward. And we think that will fundamentally be a lot better for this incident. But right now it's very raw, and it shouldn't have happened, and people are angry and people are upset with us, and we understand that. And I agree with them, and for that, I apologize first and foremost.
It seems clear that a mistake was made, multiple mistakes, frankly, on different people's parts, not just the banks. Was there an internal training issue? I mean, can you identify and say, we need to stop doing X and this won't happen, or was it a human error?
Yeah, I think it was broader. I think we take accountability, and I say we because it's all of us, in the fact that the escalation that occurred shouldn't have been an escalation to authorities. So we're responsible for that. Training is part of it, but it's also a broader conversation in terms of how we deal with these issues with respect to escalations broadly, because this shouldn't happen to anybody.
The last bit of kind of bad news that you were offering up were layoffs, restructuring charges, not something you ever want to say. Banks are a massive employer in this country. It kind of resonates through. Give me a sense of what that was about for you, what it means, and where you are with that restructuring.
Yeah, so look, we're in an uncertain world, right? We have lots of conversations about uncertainties in the economy, technology evolutions, globalization, localization. We have lots of changes, and underneath that, the best response from our perspective is a consistent strategy and consistent performance. And when we talk about consistent strategy, we've been at most of our strategies for decades, in some cases some would say 200 years at the same strategies, and we've been pretty good at them. So we've made decisions in the last 6 months when we're looking at, I would say a modest but not too profound of a deceleration in North American economies. And we've looked at our responsibilities to shareholders, and we've accelerated our performance. We're taking market share in places where we know we can win, where we've proven we can win. And at the same time, we know we have the least competitive cost structure among our peer set. And that's a fact, and we're addressing that head on. And so the restructuring you referred to, we said we were going to reduce our workforce by 5%. What that means is we're going to have to eliminate some low value work that gets done. You don't just take out 5% of the workforce and ask everybody else to do the same thing. So we're rewiring the accountabilities and the work that gets done. And as we do that, if we can do both of the things that I'm talking about here at the same time, where we can accelerate our performance in places that we can win, and we're doing that very clearly in some of our businesses, both in Canada and the United States, and at the same time get our cost structure to become more competitive, we deliver on that promise to shareholders because, as you know, in Canada, the customer very often is also a shareholder, is often in the community, so we have an accountability on all of those fronts to follow through on.
And it happens in a landscape, of course, domestically, where, to your point, I mean, even the IMF numbers today reflect we still get growth. It will be slower growth than many thought, both globally and for Canada. But here we have some very specific issues. So where does, for instance, in the domestic market, household indebtedness, concerns about the mortgage market, where does that fit into kind of your thinking about your own cost structure and the business of the bank?
Yeah, so I think that when you talk about household indebtedness, of course it's a factor. We watch it very carefully. We watch it weekly. We study it. We consider our exposure to it. We happen to be the least exposed to the Canadian household relative to our peers in Canada, but that really isn't, I wouldn't say is the most important point. I think the most important point to think about is when you look at household indebtedness, you also have to consider the other side of the household's balance sheet. And we're also seeing that the other side of the household's balance sheet with liquid investments, illiquid investments, and the wealth effect is very positive. So we're not actually that concerned with household indebtedness from a pure risk perspective. We're not seeing any trends. When I think about The other part of your question, when you're talking about its implication on the Canadian economy, I think by far the biggest influence on the performance of the Canadian economy is the US economy. And in the US, I've said recently that I thought the US economy might slow down to something between 1.5% or 2%. If you asked me to pick a point in that range 3 or 4 months ago, I probably would have picked 1.5%. Today I'd pick 2%. I actually think we're seeing a little bit more confidence in the commercial side of the business and the corporate side of the business, and we're seeing a little bit of a release relative to what we would have seen in capital formation 3 or 4 months ago. So net, is that number likely to be higher than it was in 2019? No. So we are seeing a slowing, but if we're seeing a slowing to something like 2%, that's not bad, and that's actually, at the end of the day, reasonably constructive on a relative basis for Canada as well.
There are these big, of course, exogenous risk possibilities. Trade remains one of them.
Yeah.
We've had some good news on the trade front, I guess we'll call it that.
Yeah.
What's your feeling about where that goes from here?
Well, first of all, I think you can call it that. I think you can call it good news. If you look at the slowdown that we take the U.S. economy right now, first of all, the consumer remains very healthy. There isn't any question about that. The slowing that we've been talking about is mostly in commercial and corporate that we've seen in the U.S. economy. And the only fundamental reason for that is trade and tariffs. There's nothing else we can see in our models that should cause any slowdown other than that. And it feels a little bit to me, like if you think about 2017, when we saw the expectation of fiscal reform. So we had a new administration in the United States. Everybody knew there was going to be fiscal reform, but they didn't know what it was going to be. So what do? You sort of pull back on your spending and your CapEx and your capital formation. And then when there's clarity, we saw a big release, and we saw a very profound release of capital formation in that sector of the economy in 2018, and I would say about half of 2019. That was coincidental with the time that the trade files were accelerating. So then you saw the same pattern repeat itself. You saw a bit of a pause to the back half of 2019, and now here we are in early 2020. The positive news you referred to with the phase 1 deal with China, I mean, the way I think about it is it's a removal of some of the downside risk. And the probability, if I had to guess here today, and we talk to all of our clients about this all the time on both sides of the border, the probability is that if this runs its course through until the election, the general election in the United States, which is around the corner, we're going to wake up and we're there, we're 10 months away from it, then what we'll have seen is a truce that gets us from here to there. And as a result of that, I think you'll see a little bit more of a release in capital into the U.S. economy. Then you have the consumer performing well, and you have the commercial performing okay, which gets me more confident at 2% than at 1.5%. It's not a bad outcome. It's not a bad outcome for the U.S. and probably therefore not a bad outcome for Canada.
And of course, the Chinese side of the equation, there's some positive action there, right, as we see tariffs reducing. China's also opened up its capital markets a little bit. We've seen a big push by American banks into that market. Yep. You're already there in wealth, and there's some other places that you have exposure. Yep. Yep. How big can you go in China?
Well, we've been in China in wealth and in capital markets for decades. We've been there, and we were early, and we've got a license, we got a banking license in China as well. So we've been pretty well invested for a long time. For now, our position with respect to China is we like what we've got, and we're watching very closely. Our marginal investment dollar has tended to be to the United States in terms of our growth dollar, because we can see a clearer return in the near term. When we look at our businesses in China, they're great conduits and corridors to our businesses in North America, in capital markets and in wealth particularly. So we're not looking to, you're not going to hear me say today we're going to double or we're going to triple our business in China.
Or get into domestic retail business?
No, we're not going to do that. We're going to continue to optimize what we've got in China, and it's working well.
And in terms of where you do see other opportunities, you mentioned that incremental investment in the U.S. Is that where you're focused? Is there still Canadian investment to be had?
Well, there is in both places, but to me this is all about consistency. And when we talk about, I said earlier, the best response to an uncertain environment is consistency. And when we talk about consistency, we talk about consistency of strategy, performance, and of purpose. And for us, that consistency goes right across North America. So if you let's look at commercial banking, for example, for us. We've been in it a very long time on both sides of the border, invested for decades. We've got consistent risk practices, industry practices, sales spine, brand alignment. And so when you're that consistent, we're now able to say this is the number 2 commercial bank in Canada and gaining share. It's the number 10 commercial bank in the United States and gaining share. You put together, it's the number 6 commercial bank on the continent and gaining share. That's a consistent performance, and when I see the returns out of that business and you ask whether I want to invest here or somewhere else, it's a pretty good place to invest. That's an example. In the meantime, in Canada, our Canadian P&C business has started to perform on a relative basis compared to its peers very well. So when I keep coming back to this point on consistency, it's about consistency on the strategy and then the performances of the businesses as a whole. And I think that's what our customers and our investors should expect from us as we go forward into 2020 and beyond.
Where are you on the risks on the commercial loan side? The credit cycle is long in the tooth, and we're starting to get those warnings that sound like dog whistles, right, from people like KKR saying, watch the BBB downgrades. Yeah. Are you concerned about that?
So of course we're concerned about it. We've always been concerned about it, but those dog whistles started to blow 5 and 6 years ago, and because then people were saying, well, gee, we're 5 years out of the crisis, and therefore it must be this year, it must be this year. So I wouldn't say to you we're more concerned than we were a year ago, because we were concerned a year ago and we looked very carefully at it. We continue to look very carefully at it. So far, I would say we have not seen systemic patterns across the board when you look across industries and you look across geographies, but you start to see some isolated circumstances where there might be a larger credit that might be problematic over here and another one over here, and then we spend a lot of time trying to figure out whether here and here has any relationship to each other. And so far the answer is it doesn't. So I think what you'll see is generally you'll see some escalations that are not connected. When you start to see patterns that are completely connected, either geographically or through sectors, then you can come to a conclusion that we've got a real turn in the credit books, but we're not there.
I just want to hit the sustainability issue. Obviously, it's top of mind. You head to Davos, it's going to be on the agenda. BlackRock's put it on the agenda. Yeah. You have a big oil and gas business, and that is in the sights of many who are taking on this sustainability issue. Can you square those things for the bank?
Yeah, look, so we talk about the purpose of our bank, and we talk about it to boldly grow the good in business and in life. Underneath that, we've got 3 core pillars, and one is sustainability. So we've committed $400 billion to sustainable finance. We're seeing that real live in some of the work that we're doing. We've issued green bonds. We've done it on behalf of Maple Leaf Foods, where we issued a sustainability-linked loan. We're doing all of that work with our clients and through our wealth management businesses. And you go back to the conversations that I'm sure we're going to have this week at the World Economic Forum. They're all around sustainability and they're around economic inclusion. Those are at the core of the purpose of our organization, so we're completely aligned. And with respect to our investments and our support of the legacy fossil fuel client base in Canada and the US, by the way, for us it's all about the transition. It's all about supporting leaders who want to transition over time, and it does take time and it will take time, to a lower carbon economy. And for us to turn around and say we're not interested in supporting that transition because of something that somebody's saying anywhere in the world doesn't make any sense, because if you do that, we'll create more problems. So we're completely invested. We want to be leaders in that transition, supporting that transition, and that means aligning ourselves with the leaders who are doing it. And there are lots, and I think Canada, by the way, is and has the opportunity to enhance its reputation as being leaders in the world on the transition.